Okay, greetings everybody. Back again, Bill Moore, the developer of the Trade to Win course, along with Tom Basso, the great and famous author, trader, one of the most accomplished and most one of the people I admire the most in the trading world here. So thank you for being with us. I do want to mention before we jump into the topic here, which is going to be risk management, that Tom has a new book coming out called The All-Weather Trader. By the time some of you guys are watching this video, it might already be out. Check the links in the course, and if anywhere this video is going to be, there's going to be some written words there. The links to Tom's book will be included there. So please take a look, and please avail yourself of his wisdom on these topics. So he also has a book about risk management, I believe, in the past, and that's a topic that he is a market wizard on. Anybody who's going to be good at trading long term must have risk management in mind from the beginning. And there are a lot of, I'm going to say, simplistic perspectives. It's better to have a simple risk management plan than no risk management plan, right? So a lot of people say never risk more than 2% of your bankroll on any one trade. Some people actually reduce that to 1%. I think if you can do that and keep the discipline that we've talked about before, it keeps you from going off the deep end, both when you're winning and losing too much. But Tom has some very deep insight into this topic. So I would like to turn it over to Tom, let him enlighten us on some of his ideas about risk management.
Well, thanks, Bill. That's a great introduction. And thanks for the plug of the book. I have to give a lot of credit to those who came before me. Larry Hite, who was also in the first Market Wizards book. I was in the second, New Market Wizards. Larry said something that hit my mathematical brain perfectly. So I have to give him credit. He said that he was running mint management back in those days. They were about $1 billion under management. He said, we try to make our bet size the same on every trade. And I thought, bet size, that's weird. That's an interesting way to put it. And I started questioning what that meant. And it wasn't that he was doing the same amount of shares. It wasn't that he was doing the same amount of contracts of gold or oil or anything. The bet size was the same. So I started reading more about what he was talking about, and I gathered he was referring to risk. And there's where you had, in the introduction, talked about never risk more than 2% of your assets or never risk more than 1%. I currently run my retirement portfolio at 0.5%. And I have a fairly large portfolio, and I don't have a huge appetite or need to try to produce 100% return or anything in my life. I just don't want to have the money go away. I'm retired. I want to stay retired. So 0.5% works for me. It keeps the drawdowns a lot lower, keeps the returns comfortable. My position sizes aren't that huge then. Markets can tolerate the movement. Everything's good. So I think the important thing to learn from Larry and myself, what is risk? Risk to me is you're going to get into a market, you're going to set your stop point someplace, your stop loss area. You say, if it gets to here, whatever happened, this trade, it's a loser, I'm out of here. Cut your losses short, let your gains run. So that's one way you could look at risk in dollars, and you could always turn that into a risk percent. How do you do that? Well, you got equity. These brokers are all electronic these days, so you know to the penny where you are in the last 30 seconds on your equity figure. So you can take that as a denominator and take the dollars of risk on that trade as a numerator, and you can know exactly what the risk of that trade is in percentage terms. So let's say I start a trade and I'm going to buy gold or something, and I'm going to do 0.5% of risk. I'll take my equity, multiply it times 0.5%. That's my allowable risk that I'll take on in gold. So then all I got to do is go back to the chart and information on gold and say, well, what's one contract of gold? Well, maybe it's $500 or whatever. And that's one contract. And I just ask the question of, hey, I can take on this much risk in dollars, and I've got 500 per contract. Divide the two, it tells me how many contracts to buy. That's what I buy. So position sizing just gets as easy as doing 7th grade math.
Okay.
All right. And that's in my book, Successful Traders Size Their Positions. All the formulas are there. It's really easy to follow. A lot of people don't do what I'm going to talk about next, though, in risk management. Because I was a somewhat longer term trader and not day trading all the time, I'm going to have positions that I end up rolling. I remember one Japanese yen trade back in the day where I think I held it for like 4 or 6 quarters. So I'm a year and a half I'm in the thing. I'm rolling it every 3 months. Well, I think what you want to start thinking about is, and it's that fateful silver trade that was mentioned in my New Market Wizards chapter, the conditions that exist in that market, that when you got in, that day you got in, don't stay static, they change. So logically, the risk of your position changes on the fly. So why not manage your position size based on how the risk and volatility is constantly changing out there, and control that to a certain acceptable limit? And in my case, I start out with 0.5%. If it gets to 1% or more on that position, I start peeling back positions until I maintain my 1%. So I don't let the ongoing position, even though I'm making a lot of money on it, and like I was just in on an orange juice trade where I was just making scandalous amounts every day. But if it got over the 1% rule, I just peel off a contract or two or whatever it takes, get it down to my normal level. And that's one thing a lot of traders don't do. Once they get a big profitable position, they hold on for dear life and like to the bucking bronco and try not to get thrown off. And I just don't think you need to do that. I think your return to risk will be better by managing your ongoing risk. And I think your ability to be Mr. Serenity is definitely increased. You get a lot less stress.
Right. And that's very interesting. We've taken a look at times at managing risk using some of our predictive models, right? Now, our predictive models give a risk number as part of it, right? They said, okay, this is the expected number, but it gives some risk numbers with it, and taking a ratio of those things gives you a good idea. Well, gives you an idea anyway. Depends how much you trust your models, but gives you an idea of the risk compared to the potential reward on that particular trade. And we've played around with sizing based on those numbers. I can't say that I've taken it out to a full system though. I have examined it and looked at it and I've done it for small periods of time on some trades, but it is, like you were saying earlier, it's work, right? It's work to do all that and making all those decisions. So it probably fell by the wayside more because the other risk management tools we had were easier, not because it was wrong, But you feel like you have that concept down. So yours is pretty straightforward though. Yours is pretty much
7th grade math. I learned all that math in 7th grade. I tell you what, the reason I like the way I'm doing it versus what you're talking about with the predictive nature and sort of a return to risk prediction is that when I'm measuring risk, I'm measuring actual real dollar risk from where the market is this second to where my stop is. And as the market moves around, I can tell you exactly what my risk is. There's no prediction involved. It is. If it turns around, goes to my stop, I'm going to lose this much money. And that makes it really simple to then say, I want to manage. I don't want to lose any more on this position than X percent. I can lose 0.5%, that's fine. Or I can lose 1%. And all traders that are listening to me talking right now should know that they should dial that in where they want to. If they want to be very aggressive and do a 2% of equity risk, just understand that you're going to get a wild ride, the higher potential to blow up. You're going to take on a lot of stress, but you will potentially, if you can ride the bronco and stay on the horse, you can make more money that way than say Tom would be in his retirement account. I think trading is dialing it in for you. Your situation, everybody listening to this situation, including Bill's situation and my situation, is different. we come from different backgrounds. We have different computer skills. We have different amounts of capital, different markets we want to participate in, different time periods we can deal with, different indicators that we want to use. I think finding what works for you within your time frames, within your computer capability, let's say, if you're going to use computers or not use computers, designing all that so it fits you like a glove is going to help you be successful, because trying to do something that is uncomfortable and you can't handle, like taking on too much risk, and you're not mentally prepared for it, you're just shooting yourself in the foot long term. Sooner or later, the markets will find that weakness where you mismatched what you're doing to you, and it will teach you some nasty lessons.
Well, I think the way you worded it just then, when you have this much risk and you're not mentally prepared for it, that's showing you how tied together the risk management is to the trading psychology. Because if you can't deal with it, don't do it, right? Just don't put yourself in the position that you're going to have a bunch of trouble, and you're going to have a bunch of trouble if you're not, as you just put it, mentally prepared to handle that, right?
Exactly.
No, it's very, very interesting. I have a question. This might be a little bit off topic, but what about things like the Kelly criteria or things of that nature for sizing and risk management? Have you looked at those and used those before?
Yeah, I've looked at that. I mean, if you look at Tharp's definitive guide to position sizing, which is, great for use as a doorstop if you want to keep the door from blowing shut in the wind. It's a massive document, and I've read the entire book. And I've got a chapter in there. He was nice enough to say some complimentary things, and with my permission, I gave him all the math, and he included it in there. So he calls it the Basso position sizing technique. It's not mine; anybody can use it. It's simple math. But the thing that I discovered looking at Kelly criteria and some of these other ones, I think they push the envelope way too much sometimes, and if you're trying to maximize your returns, you're making a lot of presumptions in some of these position sizing algorithms that history is going to be exactly similar to the future. And if it's not going to be a fun ride at all.
No, that's right. That's right. I completely concur in my experience with that. I mean, if you think about it, every model, if you're doing things like pairs trading, which I do, you're never going to put on a position that doesn't look like it's going to perform really well. Why? Because it's using the historical numbers as the input. But so why don't we always get that performance? The reason is because that historical situation isn't what's happening right now. You don't know it for a few weeks. So you still have to use all the traditional risk management and ins and out kind of techniques, because your pairs will never perform as well as your model did. Because your model, you're not going to trade pairs that didn't perform well according to the model, but they could be breaking right now, right? Whatever caused it to break might be happening right this minute. You just don't know it yet, right? So I think that's the same thing with that you were referring to when you're talking about the Kelly criteria, is that the Kelly criteria is wonderful as long as the historical numbers continue, right? Continue into the future, the historical traits or whatever you want to call them, but in reality,
you and I know is not going to happen, and therefore,
right. Well, it's not going to happen across the board anyway, right? It's going to break in a certain percentage of them.
It's kind of like the old saying that the general is fighting the last war, not the next one. You have to, as a trader, realize that the future is going to have a lot of new wrinkles thrown at you, and you're trying to come up with a concept that's has very little in the way of filtering or complexity, because the future will not be like the past. And by keeping your parameter sets down and keeping your risk managed at a level that you can tolerate, it allows you to proceed into the future and roll with what the future is going to throw at you, knowing that you will never have seen exactly that type of action in the past in the databases.
Right. That's right. I think some people, like in the Black Swan, I mean, that's the theme, right? That's the theme, is that things happen that you didn't see. They're not into the model because they don't happen frequently enough, right? So you're not going to find it in your model. So
exactly.
Very, very great stuff. Great stuff. Anything else before we jump on to some other?
I would add that we talked a lot about risk as dollars, but I would say that mentally speaking, risk is also what people fear to some extent. And I think mentally speaking, if something moves too fast, it catches your attention. Something that's sitting there doing nothing does not catch your attention. So it's not, in a volatility sense, risky. And there's a lot of traders out there that would argue against me and say that no, volatility is not risk and you shouldn't worry about it. You should just, grit your teeth and deal with it. I would say if you have something moving extraordinarily too fast and it really starts catching your attention and emotionally pushing the trader's buttons, then managing volatility also as a percent of risk is another approach that can help you psychologically keep on an even keel. And what I mean by that is start with, like, I think I use 0.3% of equity for my volatility on a position. And I believe I go up to like 0.5% or something to maintain the ongoing position. So I don't ever let any of my positions start moving the portfolio around so much that it catches my attention, and therefore I can stay Mr. Serenity. So right. I would add that little wrinkle. It's the same concept as what we talked about in risk as a percent of equity. And I use things like ATR, average true range, formula at investopedia.com. Simple math again, high school, junior high school math. We got to do a moving average now. That might be high school, I don't know. And it's really simple stuff, but it really smooths out the portfolio, improves return to risk ratios, helps the psyche. And I think anything you could do that does all three of those things might be a good thing to consider.
By the way, I use ATR on entry and exit signals, both. I use it both ways.
So what you're doing there is using a buy-sell engine that is actually more robust because you are allowing it to adjust itself to the ongoing changing conditions in the market versus, say, a fixed moving average, which might be perfect for last year, but is terrible for next year,
right?
Which is because it's fixed. You're allowing your indicator to adjust. Brilliant.
Yeah, absolutely. So, that is absolutely superb. What is the name of your book about risk management again?
The book that's coming out at the end of the month from the time we're doing this interview is going to be called The All-Weather Trader, Mr. Serenity's thoughts on trading in up and down markets. Or no, come rain or shine. It's a weather thing. Mr. Serenity's thoughts on trading come rain or shine.
Okay.
And what it really is it's kind of my trading autobiography. It tells the story of how I started with no knowledge of any of this stuff and just started building layer upon layer upon layer, and eventually arrived at a very nice retirement and trading my own money and having a good time in life. And I think I cover the mental side, I cover the position sizing side, cover a lot about buy-sell engines, a lot about multiple systems trading. There's a lot of stuff in this book. It is really everything I got all in one place. So,
well, I'm going to get a copy of it when it's available and get it signed when that's available.
Okay, it's a deal.
Okay, thank you so much for this part of the lesson, and I want to talk with you when we're off this and see if I can entice you to do a very short fourth lesson with us here. So anyway, thank you very much.